Hello everyone, it's Christian here from Sanktuary. Today is the 21st of September 2016. I'm going to do something a bit different again today. What we're going to be talking about is how you can become part of the 5 to 9% of traders that actually make money. Now this is quite a difficult topic to actually talk about based on the number of fake education programs that are out there, the amount of fallacy sort of kind of ideas that are put up in people's mind, the false dawns, false hopes, the holy grails, all these sorts of things. So what I'm going to try and do is give a little bit of an insight into how to form a good trading strategy by which you can continue to build your accounts profitably, but giving you the honest truth of how you're going to do that. It's not going to be an overnight process. So the first thing we need to look at is essentially, why do so many traders actually fail? Now there's a number of key different reasons why that is the case. For example, they run their losers and they cut their winners. That's one. They're not patient. That's another. They're also kind of not apt with regards to how to position themselves in terms of their trade sizing. So whereas they've got an account with £500 in and they're trading CFDs, for example, they're putting on one or two lots with a ridiculously high margin of say 500 to 1, whereas the normal trader and kind of professional would be looking to probably put no more than say 0.2 lots on for that sort of amount, with a much lower leverage of around 20 to 1 or even less, to be honest. It depends on the minimums that your brokerage allows. So basically, what we're going to look at is what's known as the rule of inversion. Now, this is kind of an idea that was brought upon by earlier physicists and kind of links to a bit of Einstein, really. And basically, if you want to solve a problem that you can't find the answer to, try and flip the problem the other way around. Flip it on its head. Now, you see a lot of people, engineers, a lot of the creative thinkers, those sorts of individuals, when they're brainstorming ideas, they'll hang upside down. They might sit on their sofa, turn around and moving about. The legs then become where the head should be and their head is on touching the floor and they're kind of thinking. But it allows you to give a different perspective to something that you're trying to think about and kind of lets the creative juices flow there. So we're going to try and use that sort of framework to form our framework to be able to profit successfully from the markets. Now, the first thing I'm going to look at is this whole idea of cutting losses and running winners. Now, this is quite an apt thing. Now, a lot of people will look to go into the markets and try and get a home run every time. They think, okay, this one's not going to be a loser. This one's not going to be a loser all the way through. Oh, they've made a bit, etc., etc. But the main problem is that it's very rare to actually have a home run, and often the people who have home runs consistently do so not because they're fantastic traders, but actually that they don't understand the true level of risk that they're taking. They actually perceive a certain level of risk, but actually the risks are much higher and they've kind of got a little bit of luck on their side. Now, we all hear of the whole aspect of cutting losses and running winners, but there are times also where winners won't actually run as far as you think, and losers won't actually go against you as far as you think. I'm sure we've all been in that situation if we've been trading our own accounts where we've gone, I got out a small loss, look, and it all came back and went to my profit target and beyond. That's just the game. It's one of those things where you just have to go, right, I'm out, I got it wrong, move on. Keep an eye on it, keep your trading journal, keep an eye on those trades, and kind of, if they're happening more often than not, then have a little look. Maybe you need to reduce your position size, but then have a greater kind of number of pips before you get out. So the risk in terms of monetary value is the same, but you're allowing yourself to have more opportunity to let it ebb and flow in a loss before getting you out, so to speak. Because even though people cut their everyone gets told cut your losses as soon as possible. Often, this sounds quite counterintuitive. That's not the best thing to do because markets are volatile anyway. So you can have quite a lot of whipsawing just from the normal. Even if the market is trending upwards, it's kind of just flicking back and forth, and the size of the high and the low, the kind of small channel that is forming just from ebbing and flowing might actually be large enough to actually cut you out of those positions, even if your direction is right. So it means then that if you're employing this sort of strategy, you need to have your timing spot on, which a lot of amateur traders don't actually do. The reason they don't have this timing down is because they're impatient. They're in the markets, they switch on their screens at 5 to 8 in the morning for the UK Open at 8, and as soon as 8 o'clock they're there with their trigger happy. Then you see them twitching their index finger looking to enter a trade. Now, yes, some people do actually make money just off the UK Open and also the US Open, but they tend to actually understand what they're doing and where they want to be involved. Often the best trade is actually to sit on your hands and not be involved. I mean, I've had days where I've felt quite guilty, where I've sat on my screen for a couple of hours. I've been sitting there for 4 or 5 hours, and even though I'm looking through all my charts, I've got about 25, 30 on my watch list of foreign exchange pairs, commodities, and global indices. There aren't actually any opportunities there. So even for 4 or 5 hours, I haven't actually made a trade. And I feel very guilty thinking, right, I should be looking for an opportunity. That from personal experience, what I've actually done and learnt is that to actually sit in your hands and not feel guilty. It's fine. Just move on and do something else. I might write a blog post. I might write an article. I might be doing some Skype calls with some potential clients. Anything like that. That's not a problem. Just that's learning through experience, because even though you're not taking a trade, the money is still within your brokerage account for the next day. You're not then coming in the day after thinking, look, those opportunities weren't right. I kind of half-assed those setups and look, I lost money. You kind of ensuring that you're taking the best setups that you can, and there are times where the market doesn't move the way in line with a strategy that you need to employ, and that can happen. Like September is, well, I found this year relatively quiet. I mean, you got a couple of explosive moves, but you're not always there to actually get on the back of all of them. Some of them are unexpected news. Some of them are in the overnight session, especially in Australia, New Zealand, that sort of region of the world, that you're not actually awake to actually be part of. And based on the actual setup that you were looking at, there's one I did yesterday on our daily dose with the Aussie dollar and US dollar. Well, the breakout actually occurred on that pair, but my personal opinion, I didn't think it would be as strong as what actually happened. So it was one of those things where I'm not going to stay up all night to look for that opportunity, because I didn't think it was actually going to happen. Okay, so another thing that people don't do is that they, how can I word this? They actually sell breakouts and those and buy breakouts, those sort of things. They think, and it's a previous video on the reason why you're trading range breakouts wrong, which is on the YouTube channel just there. It was yesterday, the 20th. I uploaded that. So that's basically going to go through the reasons why many people trade ranges wrong, and essentially what they're doing wrong. But it epitomizes the idea that they're going in and they're putting in stop entry orders above and below the traded range, and as soon as a breakout occurs, they think, I'm going to get on the back of that and I'm going to have a home run. Not actually thinking that the majority of breakouts actually fail, and that actually gives the professionals an opportunity to sell into that kind of dumb money in the market and get a better entry price for their with the trend trade. So you kind of got to think, where's the trade going? Are you going to have a bullish breakout and a bearish trend? Conversely, you're going to have a bearish breakout and a bullish trend. It's one of those things where a lot of the professionals, they might let the breakout go a little bit, but they're just going to use that as almost like a value opportunity where they'll just buy it all up, and they've got far larger order flow than us little day traders and swing traders that will be able to kind of overpower the market, move the market back up, and the bullish trend will continue in that situation. Another thing that we need to look at now is, so how are you going to put this all together in a strategy for you to actually employ? Now, there's a blog post on our website on sanctuary.co.uk. You can kind of see here, it's the blog page. If you click on that, there is a blog post that I wrote about a week ago, actually stipulating how I do not believe social trading is as good as people are making out. Now, there's a number of reasons why that is, and please do have a quick look at the blog post. I don't know why the computer's not loading. Basically, the blog post is looking at things like Darwin X, eToro, why they are not good. These sort of companies are selling the idea, here it is, that by having a community of traders, that's actually going to help everyone learn and be beneficial. It's not. There's a lot of spoofing out there from people who think they can spoof, even though they don't really realise that they're tiny in a market that they have no control over. And based on the idea that we've already spoke, that 91 to 95% of traders fail and consistently lose money, why would you want to listen to them? You actually want to use them as a contradictory indicator, so to speak. You want to do the opposite to them, and then you should come out better. Now, of course, I'm not saying that every trader on these sites are not good. I'm not saying that at all. But what I'm saying is, if we use the kind of probabilities that we've been using, and the fact that there's no barriers to entry in terms of opening an account here, you can kind of stipulate that the vast majority will be people who lose money. So I do advise you check out that post. This social trade is not as good as it might first seem. So in order to do your own strategy here, the one thing I would do is definitely have a look at that range breakout strategy. What you want to be looking at is kind of understanding with the range you're going to have a certain tolerance with in terms of support and resistance, and the dumb money, as soon as it breaks out one price above, will be looking to get in thinking it's a breakout, and that's where you can be looking for those long wicks and the opportunities there to actually go against them and over the course of many trades make money. Now, of course, breakouts do actually occur, so you actually have to make sure that you are tight on your risk there as well. It's one of those opportunities where you might let a couple of long wicks get in, but that you never know, the market could actually have a breakout, and you need to be looking to either take a small loss there or hedge accordingly, so to speak. But the important thing to note is that as long as you manage your risk on those sorts of situations, the probabilities over the long term are with you, so that can give you a bit of confidence, provided you're consistently using the same trade position size, etc. So that's one aspect of it. Another thing is, as we said already, kind of give a bit more tolerance to some of your trades in terms of pips that you're allowing it to travel. Reduce your trade size to allow that, so you can kind of not getting stopped out of trades for little losses too often, so to speak. And everyone says there's nothing wrong with taking your managed loss. Absolutely. But if you're taking that consistently, then maybe you're not taking into account the actual true range that the market's willing to trade at, and you might need to reduce your position sizing to kind of combat that and give it a bit more flexibility there. Of course, with breakouts, be very, very careful. You do not want to be holding positions. Should a breakout actually occur, that could be quite aggressive. Another thing there is, as we already spoke, patience. So, as I said, if I do it, there's a couple of times where I do it, especially in September now where it's quite quiet, sit on your hands. There's nothing wrong with it. Like, I've got this video now, you can kind of see my screen. My brokerage isn't even up. I've just shut down a couple of my windows to make this video a bit more seamless, so it doesn't slow down when filming. But there aren't many opportunities there. As I said, there's a couple of breakouts which, as we said, I'm not going to be stop entry and ordering into, so to speak. But you kind of, want to be looking for, those kind of opportunities, should they be there. If they're not, turn the screens off, or keep an eye on them, but do other things. I'll be writing another blog post and article which will be uploaded later on. So please do, if you do like the idea of these videos and the content we're providing, please like and subscribe below, and I advise you, please do have a look at our blog post here. Also, when you go on the website for the first time, you'll probably be prompted to sign up to a monthly newsletter. Now, this is only going to be one email a month, kind of give an update on the business and what we're all about, and give you a couple of updates of kind of what we're doing on the YouTube channel also. So I'd advise you to sign up there, and we won't spam you, we won't give your information to third parties either, so that's good. Okay guys, so this is the end of our video for this time, so I hope some of the ideas here are useful to you. Until next time, good luck trading. Goodbye guys.